Anyone who has studied ICT and smart money will sooner or later come up against the same wall. In theory, everything is simple. There is Asia. London's task is to remove its liquidity, and our task is to go in the opposite direction. But when you open the chart, the most interesting part begins one day after liquidity is withdrawn. The market turns around perfectly and gives you a trade. And the next day, it withdraws, draws a confirmation, you enter, and the price continues to push in the same direction, hitting your stop loss. Today, we will analyze this very issue. In my experience, each session has its own specific task, and this is the meaning of the price delivery algorithm that drives the market within the day. I will show you how to read the targets of London and New York, how to distinguish between external and internal liquidity, and why sometimes the right entry doesn't work because it's not a reversal, but just a phase of consolidation before continuation. At the end, you'll get a clear filter for the day, what signs to look for to expect a reversal immediately after the initial pullback, and when to skip the first pullback and wait for the second phase of the scenario. The task is simple. After this video, you'll stop guessing and start working with the algorithm, not against it. Let's go step by step to accurately convey the idea of the price delivery algorithm. I'll only point out what is really important and what you should look at first. We'll analyze USD/CHF. You can easily apply the same logic to any asset. On the daily chart, we mark the maximum and minimum of the previous week. Liquidity below the previous low has already been withdrawn. Friday ends with a weekly low sweep and the price entering the daily fair value gap zone of interest. On H1, a short fair value gap is forming in parallel in a downward impulse. Then, the logic of the algorithm comes into play. This entire decline is unbalanced. There's a lot of inefficiency inside. The task of the banking algorithm now is to rebalance the movement and deliver the price to the premium zone. We won't rush. I'm extending Fibonacci to the entire downward impulse and waiting for delivery above 0.50. Perfectly, in the premium above 0.50. The minimum from last week is now here. This is the key sell-side liquidity we will be working with this week. Monday closed exactly as planned. The algorithm's task to rebalance inefficiency was completed. Friday's impulse was empty with no reverse delivery. Today, the price returned to premium, leaving several local liquidity pools along the way. I marked them and will use them as areas of interest going forward. Now let's go down to the lower time frame to show why it is important to understand the logic of the algorithm. Rather than blindly working according to a pattern, we remove the liquidity of the previous session. We take the trade. Look at how London opened. First, there was a sweep of the Asian range, then a change in structure and a fair value gap appeared on the lower time frame, from which, according to the textbook, you can buy. But then there is a resweep. The fresh London lows are removed. London remains in a narrow range, and only New York launches a real upward delivery. This is a classic rebalancing day. It provides context and guidance for tomorrow, but does not provide a solid entry point. Therefore, without a trade, we fix the zones and wait for the next day. Now we have an upward movement, and it's again empty without rebalancing. I do the same as yesterday. I extend the Fibonacci from the beginning of the impulse to the current maximum to divide the movement into discount, premium, and understand where the algorithm will most logically take the price before continuing. Asia takes the price into the discount zone and closes the inefficiency. The balance is restored. Now we look at where the delivery will go. In London, the scenario intensifies. They remove the liquidity of the Asian range and the local highs of the previous day, the ones we marked in advance. This is the window for a short, but first we need confirmation on the lower time frame. I switch to 5 minutes and see a downward change in structure and the formation of a fresh fair value gap. The plan is simple. Enter on the return to this fair value gap, stop behind the sweep tail, behind the London high, target the nearest liquidity pool of the Asian session. In fact, it turned out to be about 1.6. New York picks up the downward delivery and brings the price to the target. The take is closed. After the exit, I add the current liquidity pools to the chart, which I will work with the next day if there is a confirmation. Let's move on to the next day. In the center between the local pools, I mark a bearish fair value gap, an area of interest, but you need to work here carefully. One of scenarios, before the London opening, the price doesn't reach the area, but during the London session itself, it removes Asian highs and touches the fair value gap. Then I look for a short only with confirmation on a lower time frame. In fact, London passed without reacting to the zone. The price simply pushed up, so I remain in observation mode. Further, the market comes to the local liquidity marked earlier and removes it. I switch to a lower time frame. There is a downward change in structure, an impulse shift, and a fresh bearish fair value gap. That's enough. Entry on the return to the fair value gap. Stop. Behind the sweep tail, London maximum, target. The nearest liquidity of the Asian range. The ratio is about 1.5. New York continues to deliver downwards and brings the price to the target. The take is executed. I update the markup. I fixed new local liquidity pools that I'll work with in the next session. I want to remind you that the point of the video is not to show that I predict every movement. I just want to explain the logic that each day and each session has its own task. Rebalancing, removing specific liquidity, delivery to the zone of interest. When you see this, the chaos disappears and a scenario emerges. But this doesn't make the market 100% simple and predictable. So far, everything looks clear. The algorithm consistently closes inefficiencies and works from pools. But it doesn't always happen that way. Don't turn this into a template, run a backtest, go through 100 sessions on different assets, develop your own rules for confirmation on a lower time frame. Then you will have not a signal, but a repeatable process. Let's move on. Let's go to the next day and see what task the market will solve now. The Asian session immediately removes the previously marked local liquidity. I don't work in Asia, so I'm just waiting for London. In London, they remove last week's minimum, a highly probable scenario. I switch to a lower time frame. On M5, I see a change in structure. A fair value gap appears, and when it returns, I open a long position. I don't set the take profit at the top liquidity pool. The fall left inefficiencies. The algorithm's task is to rebalance the move. I extend the Fibonacci to the entire downward impulse and set the target slightly above the 0.5 zone in the short fair value gap area. Stopping under the sweep tail. Risk-profit ratio is about 1:4. Further, the market makes a local buy-side sweep, falls short of the target, and reverses. The trade is closed at the stop. This is a working situation. The setup is valid, but there was no continuation of the delivery. I mark new relevant liquidity pools on the chart, both above and below, and carry the plan over to the next week, considering that today is Friday, the start of a new week. The weekly high and weekly low are marked, and then I just watch where the algorithm will take the price. Monday didn't give a setup. In London, only the liquidity of the Asian range was withdrawn, but the weekly levels remained intact. I don't take a long position in such a place. New York tested the short fair value gap, gave a reaction, but without a continuation structure. There was no point in shorting from there, and there were not enough conditions for a long position. Last week's liquidity withdrawal. Let's move on. I'm waiting to see where the delivery will be. Asia starts with the withdrawal of local liquidity from New York. I don't trade Asia, I just watch. Next comes what was missing last week, a complete rebalancing of the short impulse. The price was delivered at a premium and the inefficiency was filled. London leaves a fresh pool of liquidity on top. New York removes it, and on the return to HTF short fair value gap, I open a short. The trade is still in the market, so I don't know how it will close, so for now I will explain the logic of this trade. The market algorithm closed the imbalance upwards, removed the buy side, London, returned to the short FVG of the higher time frame. This means the priority is down, either delivery to the discount zone of the current range or even a sweep of last week's low. In this area, I have a clear bias towards shorting. A common question in the comments: does this work with crypto? Yes, the same logic of liquidity, fair value gap, and delivery applies, but with nuances in timing and volatility. In the previous video, I analyzed the algorithm in detail specifically for crypto. The link is in the upper right corner. And since we're talking about crypto, if you trade crypto, I recommend checking out Evedex. It's a DEX with full control over your funds. No intermediaries or account blocks, no KYC, just connect your wallet, MetaMask, Trust Wallet, etc., and start trading. The commissions are lower, the interface is on the level of top secs, and there is leverage of up to 100x for those who consciously work with risk. Fast, convenient, and anonymous. Just what an active trader needs. The link to Evedex is in the description. The delivery algorithm also works great on indices. Today, I took a long position on NASDAQ. The trade closed in the black in one day. In the next video, I will analyze indices, how I read the context, where I wait for liquidity to be withdrawn, and how I choose the entry point. Let me know in the comments how interesting you find this. If it's still difficult to apply all this, start with OWL. It's not about liquidity or smart money. It's a trend-based approach with clear risks, entry zone, stop, targets, no manual marking. Based on the OWL signal, I had a trade on ETH for about $11,000. The full chronology is already on the channel. The link to the indicator is in the description. I periodically post shorts with my trades, both based on indicator signals and intraday work. If you are interested in following the results, subscribe to the channel. And finally, every day and every session has its own task: rebalancing, removing specific liquidity, delivering to the zone of interest. When you see the sequence liquidity, fair value gap, reaction, next liquidity, the chaos disappears, the scenario remains. It doesn't matter what the market is working on today. What matters is that you have a system for reading its tasks. The system removes chaos, and then it all comes down to risk management. If you found this useful, please like it and write in the comments what you think about the logic of price delivery.